Hello and welcome back to The Note. Well, I arrived in the office this morning braced for a big, difficult day. It didn't materialise, for which we can perhaps all be grateful, but you can see why I was worried if we take a look at this first chart of the oil price. The crude price tanked at the opening of trading in Asia on Sunday night in US terms. The reason for that was very clear. There had been a meeting of OPEC countries in Doha to thrash out a freeze on supply, which would have helped hold the price up. They failed to reach an agreement on that, and there was a belief that this was going to catch a lot of people short, that it was going to potentially lead to another round of sell-offs in the oil market, and that perhaps the entire rally in oil of recent months had been predicated on a belief that we would see that kind of agreement to reduce supply. Obviously, it hasn't happened, and you have to see that as being quite positive. During the day, you saw enough people deciding to buy into the market as to suggest that there really is some underlying confidence that oil has hit a bottom, that's not just contingent on a belief that OPEC will still be able to limit supply. Now, that translated into a steadily better day for world stocks. Asian stocks were down quite badly, particularly in Japan. European stocks did better, so did American stocks. The S&P 500 is at a fresh high for this year. However, there is some reason for concern if we take a look at earnings. Now, this is how Netflix's share price performed during the day. This last maneuver here comes after the close. It's with after close prices from Bloomberg data. They announced their earnings, which were actually better than expected, but they made rather more bearish forecasts than been expected on international subscription growth, and you can see that an awful lot of hope is written into their share price when it comes to the belief that they can continue to grow their subscriber base. Now, on a much more limited scale, you also saw the same thing happen with IBM after the market. Results that were, at least in terms of their official bottom line, better than expected, and a negative share price reaction in after-hours trading. So we have so far, particularly with the banks, seen the trick work, that the results have been bad, but not quite as bad as expected, and so there has been a pop upwards. Now we're moving on to the tech and the consumer sectors. It will be very interesting to see what can happen there, but there are a few examples emerging now of companies that beat their estimates but not quite in the right way and get punished for it. If we can see earnings season pan out better, then there's no reason to suggest that we can't take out the high for the S&P 500 set last May, but that still at this point is quite a big if.